Forwards are tailored contracts to buy or sell an asset for a fixed price at a fixed future date. They are negotiated directly between the buyer and seller of the forward contract, with terms that suit both parties. Because the arrangement is directly between buyer and seller, there is an increased risk that one counterparty may not deliver on its obligations. This is referred to as counterparty risk. Forwards are frequently used to manage risks stemming from commodity prices, foreign exchange, and interest rates. Consider an iron ore miner that wants to sell 1,000 tonnes of iron ore in 3 months' time. It could enter into a forward contract with a steel producer to sell the iron ore at the 3-month forward price of $40 per tonne, with settlement in 3 months' time. At settlement, the forward contract is physically delivered, meaning that the steel producer pays the iron ore miner $40,000 and receives 1,000 tonnes of iron ore in return. Effectively, the iron ore miner has locked in a sale price, volume, and date, reducing its commodity price risk and providing a known financial outcome. Consider an exporter that is expecting a receipt of $1 million in 2 months' time and wants to lock in the AUD-USD exchange rate. It could enter into a forward contract with a counterparty, usually a financial institution, to sell the USD and buy AUD in 2 months' time at a forward price of 60 US cents. At settlement, the forward contract is physically delivered. This means the exporter pays the counterparty $1 million, offsetting its expected receipt of $1 million, and receives 1.67 million Australian dollars in return. Effectively, the exporter has locked in an exchange rate for the full USD amount 2 months prior to the date it was received, reducing its FX risk and providing a known financial outcome. Consider an organisation that is expecting to borrow $1 million in 2 months' time for a period of 6 months, and it wants to lock in an interest rate for that borrowing now. It could enter into a 2-month versus 8-month forward rate agreement, or FRA, with a counterparty, typically a financial institution, agreeing to pay a fixed rate of 7% on $1 million. The borrower would be locked into paying a fixed rate of 7% on a $1 million borrowing for a period of 6 months, starting in 2 months' time. In 2 months' time, at the start of the 6-month borrowing period, the FRA would be cash settled. To calculate the settlement amount, the locked-in FRA rate is compared to the actual 6-month borrowing reference rate at that date. Let's say the 6-month reference rate is 6%. As the FRA rate is higher, the borrower pays the counterparty the interest differential of 1%, which works out to be $5,000 for the 6-month duration of the borrowing. But if the FRA rate had been lower than the reference rate, the borrower would have received the interest differential from the counterparty. As the FRA is settled, the borrower would then borrow the funds for the 6-month period at the current reference rate. The effective interest rate on the borrowing is 7%, being the 6% reference rate plus the 1% paid to the counterparty, which is the same as the original FRA rate. Effectively, the borrower has locked in an interest rate for the upcoming expected borrowing, reducing its interest rate risk and providing a known financial outcome. To recap, forwards are tailored contracts to buy or sell an asset for a fixed price at a fixed future date. While there is counterparty risk involved, they allow an organisation to lock in rates and prices, and therefore assist with the management of financial risks.